It's a pleasure to be here to speak to you today on this subject of value investing, a new look. Some of you may have read the memo that I put out in January on this subject, and it comes from the fact that I was cooped up for much of the early part of COVID with my son and his family living together, my wife and I and them. And he's an investor, and he worked me over all year on the subject of growth versus value and on the subject of technology. So I'd like to do some of that with you today. Back in 1999, I had two guys come to see me, the ex-CEO and the ex-CFO of a Texas technology company. And they wanted to see me because they were starting a fund of funds for hedge funds. And they wanted to know if we wanted to participate. And I said, well, we could put this fund in and that fund in. They said, no, we only do hedge funds. I said, oh, what is a hedge fund? And they both looked at each other. Neither one could say it. So the question is, what is value investing? And, this always swirls around us. And of course, it's under examination now. What I've put down here is, I think, a working definition of value investing. It consists of quantifying what something is worth intrinsically, based primarily on fundamental cash flow generating capabilities, and buying it if the price represents a meaningful discount from that value. I have firmly said that cash flow generating capabilities are what create value, that stocks, bonds, and buildings and companies have cash flow generating capabilities and can be valued intrinsically. Paintings, oil, diamonds, art do not have intrinsic value and cannot be valued intrinsically because they don't produce cash flow. So what's the metric for pricing them? So I hope this is a good working definition. I believe that these are the essential principles of value investing as I see it. The understanding of securities as stakes in a business, the focus on true worth as opposed to price, technical analysis, the use of fundamentals to calculate the intrinsic value, the recognition that attractive investments come when there's a wide divergence between price at which something is offered and the actual fundamental worth you've determined, and the emotional discipline to act when such opportunities are presented and not otherwise. I think this is what makes up a value investor. I consider myself a value investor. It happens that I last was a professional investor in equities in 1978. So I don't consider myself an equity person now, but hopefully I can make a contribution to this discussion. So we start off with that definition, but over time, of course, value and value versus growth dichotomy have evolved. 60 years ago, no, maybe it was 70 or 80, Ben Graham was really the first of the great value investors, and he did what we now call cigar butt investing, looking for cast off, little known, non-appreciated, not understood situations where there was something, it may not have been a great thing, but something in a security that other investors didn't understand, know about, or value. And that was ultra value. Warren Buffett was Graham's student, emulated him to a large extent, and started with cigar butts. But then, according to history, Charlie Munger convinced him to change from that, from poor assets at crazy prices to great businesses at fair prices. And that's what Warren would say he's been doing for the last, in his case, 60 years, I would say. And it's worked out pretty well. Now, in the 60s, we had the emergence of something called a group of growth stocks. And I remember in the early 60s seeing a brochure from Merrill Lynch on the subject in my father's living room. Companies that were innovating in either technology or marketing. And some of the marketing innovations like Avon were just as important as some of the technological innovations. And these came eventually to be codified as the Nifty 50 and adored, and there was no price too high in the views of the adherents. This is the point in which I joined the profession, the late 60s. Now, I believe that when you call something by a name, you have to call the other thing by a name to differentiate it. And so we got the growth, the pushback of the value school, which emphasized low valuation metrics. And I think that over time, maybe the last 30 or 40 years, growth and value have gone from schools of thought to job descriptions and allocation buckets. And you go to a consultant, they say, are you large cap growth or large cap value? Small cap growth, small cap value. And they have a bucket and they have money allocated for each. And so this causes a further hardening of the descriptions and definitions of growth and value. They've both had their day over the last 50 years, but certainly value has underperformed since '07. Interestingly, if you look from the beginning of the chart, which I think I looked at, which I think was from the early 70s, from the early 70s through 2007, it starts, the ratio of growth to value starts at 1 and it ends at 1 over that 35-year period. But in the last, of course, there were some spikes, but they returned to earth. In the last 14 years, it's gone up parabolically, and growth has far outperformed value. There's a lot of discussion about whether that's permanent, and I think that it needn't be. But I believe that it's fair to say that some or all of these things define value investing as it's practiced today under today's, as I say, hardened definition. That the thesis is based on today's operation, today's earnings, today's asset values, and not dependent on rampant speculation about all the good things that might happen in the future. That most of the industries are rather prosaic, certainly not high tech. That the companies are generally marked by a high degree of predictability, limited uncertainty, and a narrow range of possible outcomes. Usually, the businesses have strong defensive qualities. That's why you don't have to speculate too much about whether they'll still be in business or still be as profitable in a couple of years, and low valuations relative to fundamentals. And I think that this last point, low valuations, is really a cornerstone of value investing today. Now, I think that the value investor views his situation as follows versus the growth investor. The value stocks are anchored by today's cash flows and asset values, and they should theoretically be safer and their returns more reliable, even if they're unlikely to earn returns as high as the winning growth companies. The value investor, it's always been my view that growth investing entails in business belief in unproven business models and the risk of serious setback. And so investors have to have deep conviction if they're going to be able to hold on long enough, especially through the tough times. But when they're rising, growth stocks reflect a level of optimism that can evaporate during corrections. And the spikes are that you can see in 1998, 99, 2000, and so forth are and also, of course, back in the late 60s, early 70s, they are really the accretion of optimism. But then the way the spikes fall shows us how quickly that optimism can go away. And, you have very, very large losses from top to bottom when it reverses. Now, I don't believe that Ben Graham and Warren Buffett intended for there to be as sharp a line of demarcation between value investing and growth investing as there appears to be today. Graham engaged in cigar butt investing because it was uncrowded and profitable and low in risk. It may not be his exclusive focus if he were investing today. Warren Buffett is famous for his investments in Coca-Cola. Certainly a full-fledged member of the Nifty 50, one of the few that has performed well for the last 50 years. 40 years. And both men derived a great share of their success from their investments in Geico, a growth company. So they did not eschew everything that grew. And here's a quote from Warren, 1992 shareholder letter. We think the very term value investing is redundant. What is investing, if not the act of seeking value, at least sufficient to justify the amount paid? Typically, it, in the original, that is, the term value investing, connotes the purchase of stocks having attributes such as low ratio of price to book value, low ratio price to earnings, or a high dividend yield. Unfortunately, such characteristics, even if they appear in combination, are far from determinative as to whether an investor is indeed buying something for what it's worth. Correspondingly, opposite characteristics, a high ratio of price to book, a high PE ratio, and a low dividend yield are in no way inconsistent with a value purchase. So I think this is very significant. And see what he's saying, that high price to book, high PE, low yield, shouldn't rule it out from value, or from a good investment, I should say. Now, part of this is true, I think, because of the changes in the world. Everyone is looking for investments where they can make a lot of money without bearing much risk, but everybody's looking, which means they're hard to find. And for you to be the one who finds them, you have to have an edge. What do you do that others don't? 70 years ago, in 1950, the markets were much less efficient. There were no computers or data feeds. A little effort would enable you to garner information that other people didn't have just by going the extra mile. And few people understood the concept of underpriced value or how to find it. The world was a dumb place. The market was a dumb place when I started in this business 50 years ago. And bargains could be found in plain sight. And in my first few decades, it was common to find things that were just incredibly underpriced because they were obscure, exotic, or hard to figure out. Today, in contrast, companies are legally required to make complete and uniform disclosure, and they've made it easy, especially with the internet. All investors have computers and access to every bit of data that's imaginable, and they can screen the universe against a set of criteria in a matter of seconds. So it just doesn't make any sense in this new environment to think it's possible to get an investing edge on the basis of readily available current quantitative information. Everybody else has it. And lots of other people are as intelligent as we are. And so where's the edge from readily available current quantitative information? And thus, I believe in this environment, we have to look further ahead. And that investment superiority has to come from either a better understanding of the significance of the current qualitative factors, the things that everybody else doesn't see the same, or a better understanding of the likelihood of success in the future. And so, whereas I describe classical value investing as being based on predictability and working with things in the here and now, I think we have no choice but to look further out. The other thing is that we used to talk 25 years ago about defensive industries, companies with moats. And, more recently, however, IT and digitalization have changed the world, and the companies are disruptors or disrupted. And very few have full defenses. The moats, as I say, have evaporated, and many businesses have fallen prey to tech-savvy newcomers. And clearly, a great example is newspapers, which 25 years ago were considered highly moated, and today are fighting for their survival. Thus, as I say here, I think investors can't safely ignore today's technology. I think technology is changing every industry, and the companies creating the technology are prospering in ways never seen before. And here are some of the changes which are alleged, that because of the global markets and their growth potential of the internet and software, tech firms can become much more valuable than ever, and much more valuable than could have been imagined. Since many of the companies sell products that are made with code, their costs and their capital requirements are extremely low and their profitability unusually high, but don't look for a low ratio of price to book, because they're not book intensive. Because the friction and marginal cost of scaling of the internet can be so low, business can grow much more rapidly with much less capital intensiveness as they develop and scale new products. And it's easier in the digital world. It's never been more possible for companies to develop new avenues of growth, extending their runways if they are top competitors. And finally, the moats protecting today's winners have never been stronger. And thus, it seems that the winners have gotten more powerful and more effective as they got bigger. And the question, of course, is whether the regulators will allow them to have so much power. But now we get to this question: is it different this time? Every big move in the market is explained on the basis that things are different. So the rules of the past and the valuation restraints and the ways of looking at things of the past aren't necessarily relevant. And, today, fans of technology stocks say things are different, in that today's successful tech companies have unprecedented potential for high growth and great economics and great durability. The trouble is, we heard these things in connection with the Nifty 50 in the 60s and the tech bubble in the 90s. And so are they really different? We'll see. But some things certainly haven't changed. One is the tendency of bull markets to value all competitors as if they'll be successful, and to take tech stocks to very high valuations from which the unsuccessful ones will show great declines. The successful ones may decline too in the short run, but only as the beginning of a springboard. But the unsuccessful ones will cost you a lot of money. I believe, however, that fundamental investors need to thoroughly examine all situations, even those dependent on intangible assets and growth in the distant future, with the goal of achieving insight. And I believe this process need not be antithetical to the value investor's mentality. And what this really means is that if you see a company, a growth company, a technology company, an innovative company with what looks like an absolutely high PE ratio, let's say above certainly 15 or 20, where the typical value investor starts to get vertigo, that in itself is not a reason for dismissing. Maybe the potential of technology is as great as something. Now, I am not advocating growth investing over value. My purpose is to explore the mindset will prove most successful for value investors over the coming decades, regardless of what the markets do. And, just what is the right mindset? I think it's very important to realize that the potential range of outcomes for many of today's companies is very wide. And this goes beyond pure tech companies because of the ability to be disrupted. And there are considerations with enormous implications for the ultimate value of many companies that do not show up in the readily available quantitative data. Again, the most productive assets of today's technology companies, for example, is engineers who go home at night and code during the day. And they don't show up on the balance sheet. So you're by definition, you're going to have low book value and high ratio of price to book value. Whereas the industrial company invests in hard, tangible equipment, which does contribute to book value and give it same company with same price, gives it a low price to book ratio. So this is very important, and why I say you can't stop with readily available current quantitative information. determining the appropriateness of a market price requires deep macro understanding. It's impossible to opine on the valuation of a rapidly growing company from 30,000-foot level or by applying traditional parameters to superficial projections. These are complex companies, so you have to get down and know them in depth. But the point is that a knee-jerk negative reaction to simply a high PE ratio should be off limits. The key is to understand how market price relates to the broadly defined intrinsic value, which includes the future prospects. What I'm saying is that open-mindedness is something we should strive for. There shouldn't be a big distinction between value and growth, certainly not as wide a gulf as there is today. That without attaining real knowledge and fully understanding the positive case, it's impossible to justify the dismissiveness that many of us exhibit early in the face of innovation. And I know that I've been guilty of it sometimes. And stocks should not be automatically excluded just because they're from tech companies or rapidly growing companies or because they carry above average valuations. Conclusions. Value investing does not have to be about low valuation metrics. The fact that a security has a high PE ratio doesn't mean it's overpriced. The fact that another has a low PE ratio doesn't mean it's a bargain. The fact that a company grows rapidly and relies on intangibles such as technology for its success or has a high PE ratio does not mean it can't be invested in on the basis of intrinsic value. The fact that a company is expected to grow rapidly doesn't mean it's unpredictable. And the fact that another has a history of steady growth doesn't mean it can't run into trouble and deviate from prediction. Lastly, not all companies that are expected to grow rapidly will do so, but it's very hard to fully appreciate and fully value the ones that will. And I'll let Warren Buffett have the last word. He said, we don't consider ourselves value investors, we consider ourselves investors. There is no such thing in our mind as value or growth investing. I think that Warren, among other things, would describe himself as open-minded, although there are some things, as Charlie says, they put on the too hard pile. But and I think that he would advocate that for all of us.
Well, thank you very much, Mr. Marks. We now open the floor to questions for Mr. Marks. Okay, Ian Collins, I'll allow you to talk. Unmute yourself, please.
That's great, George. And thank you very much for all you do, George. Another great conference. Mr. Marks, thank you for your comments. I was just wondering, as you dig into deeper things like technology, what's your view on cryptocurrency, blockchain, Bitcoin, and the implications of all that? When
cryptocurrency started to gain prominence in, I think it was 2017, I came out as very negative. And in the spirit, and if you read my memo, you'll see it's discussed briefly in there. But in the spirit of what I discussed with you today, with my son's help, I now look back and see that I was unduly skeptical, in the sense that it was a knee-jerk reaction. I've been so successful in the past, taking a jaundiced eye toward financial innovation and calling insubstantial things at the time, that I immediately applied that to cryptocurrencies because they don't have cash flow generating capabilities. They still don't. So you can't talk about or compute anything like intrinsic value. But I came out very negative before I knew the whole story. And the important story is about cryptocurrencies is not a value investing story. Again, no intrinsic value, no cash flow generation. You can't say what crypto is intrinsically worth, but it's a supply and demand question. And it's a uses question, and that there could be supply for coins because of what you can do with them, even if they don't have cash flow properties. So I'm not positive on crypto coins. It's just that I now view my past negativism as having been knee-jerk skepticism and thus premature. And I don't I haven't learned enough about Bitcoin to be able to decide which case I prefer. Since I'm a value person, it may not be easy to get away from that, thinking about cryptocurrencies. But the answer is I'm not making pronouncements at this time. I got smarter in the last 4 years.
Thank you very much, Howard and Ian. Richard Alfield, nice to see you, Richard. I like the talk.
George, thank you. And Howard, that was an absolutely fascinating talk. But I wonder whether I can interpret your talk in the following way, that this is a call from a veteran of the profession to say, we who are value investors, using that term that Warren Buffett doesn't like, mustn't despise growth investors, mustn't be contemptuous of their way of thinking. And likewise, growth investors shouldn't be contemptuous of a value investor's way of thinking. But I wonder whether it is realistic to expect those of us whose bag has been through, in my case, about 35 years of investing, to do the things which are so very much not in the blood, and to look at companies with high P ratios, with the sort of micro understanding that you're talking about. And is it not legitimate to say, well, this is my bag, and I'll go on doing it this way and try to be successful at it. And I recognize that there will be people who are doing something quite different, which is completely legitimate and may be successful, and it may even be more successful. But I can't change what is in my blood. How do you react to that, Howard?
Well, no, I fully get it. My reactions to, for example, my son's investments is still what it always was, because it's 50 years of conditioning, Richard. But here's the real question: do you need a partner? If you go back to the book The Money Game by Adam Smith from the mid 60s, this is when the growth stocks were taking off, and there was one old guy in the brokerage firm called the Great Winthrop who had the best performance in his accounts. And so the author said, how could that be? He says, you want to know the answer to how I'm prospering in this market? Come in the back. And in the back, he had 3 kids, Huey, Dewey, and Louie. And he said, it was Billy the Kid and Bobby the Kid and Johnny the Kid. These are my keys, because you got to get yourself a young man. And but certainly, I mean, look, somebody like you or me, it's unlikely that we're going to retread ourselves and recreate ourselves as seers of the future. But the point is, you can get a partnership with somebody who does, and maybe that young partner can do a good job with the growthier things. But the point is, you can stick to your last, but at what price?
Douglas, I'd like to talk. Douglas Stoddard. Yeah.
Yes, thanks again. George. Mr. Marks, wonderful chat. And I did read your article in January along the same line, so it's good to get a review of it. And I was more interested in, your mindset in I'm imagining there were several debates with your son, and those of us who are parents know our kids do push us in new directions. The mindset, that you sort of tried to exhibit, I guess, during these debates and chats, you're obviously established in patterns of thinking, successes over the years. Can you speak to that, sort of as you began to change your mind on a few things, describe some of that for us?
Yeah. Well, it was really very intense, actually, living together. And, we started off probably the opening was through Bitcoin, because, he said, well, why did you reject Bitcoin? And I said, because it has no intrinsic value. And things with no intrinsic value cannot be invested in intellectually, analytically. That, the only form of intellectual and analytical investing is where there's an intrinsic value to anchor to, so you can compare the price. And so he said, well, what about Jackson Pollock painting? it has no intrinsic value. It doesn't produce cash flow, but would you like to have one? And I said, yeah, I wish I had one. So why would you want it? Well, in part because it's attractive, but certainly in part because I think it's going to go up. So the point is, people, lots of people make money trading things that have no intrinsic value. 6 or 7 years ago, we bought half of an oil trading company. Now, how can you make money trading oil? Oil has no intrinsic value. They make money incredibly steadily. So I think that was kind of eye-opening. And I am impressed by the argument that there's no reason why you should be able to get an edge based on the readily available qualitative information about the current. And I'm a believer in market efficiency to a large extent. I believe that there are efficient and inefficient and less efficient markets, and there's every reason to think that the U.S. stock market is approaching efficiency. Now, of course, the value investors think that it's biased against them, and I do think that there are trends, popularity. Ben Graham said that in the short run, the market is a voting machine, and people have been voting for tech recently. But the question is, how much is that going to change? If you knew the real tech winners, I think that they would have a great future. The question is, can you know it? But anyway, this was a very evolutionary process over the course of, well, I guess it started just 13 months ago. He moved in with us on March the 13th of last year. But I think open-mindedness is a great thing. As you will remember seeing in the memo, there was one great value investor, famous value investor, I don't like to use names, who did very well in the tech bubble especially in 99. And 99 was a horrible year for value people. I think it was the worst year in history for, well, maybe before last year. But I think that the growth beat value by 2,500 basis points in 99, as I recall. So I ran into this famous value investor who had a great year. And I said, how did you do it? He says, well, I was lucky. I had Amazon and I had this and whatever else he was talking about, maybe Apple. And I said, well, how can you own those as a value investor? He says, they look like value to me. So I think it's a question of just opening up your mind as to what can constitute value. It doesn't have to be in the present. It doesn't have to be absolutely predictable and quantifiable. And it makes it harder when you venture away from the quantitative and away from today. But I think you have to get that edge.
Yeah, so this person submitted this as anonymous, but so they say that, dear Mr. Marks, predominantly Oaktree were debt investors. However, lots of investors on this panel are anti-debt and pro-equity. If you were starting out as an investor today, would you become a debt investor again, or would you be investing in something else?
Well, I was very fortunate because when I started in equities in '69, and I did such a bad job that, well, I should say that the Nifty 50 were so unsuccessful, with which I was driving that bus. I was assigned to drive the bus, but I drove it nevertheless. That when we brought in a new chief investment officer, he wanted his own director of research, so I was out of a job. And he said, I want you to start a convertible bond fund. So I moved into the bond department, started the convertible bond fund. And then in 1978 summer, I got the call to change my life. It was the head of the bond department. He said, there's some guy in California named Milken or something who deals in something called high yield bonds. Can you figure out what that means? Because we have a client who wants a high yield bond fund. So I took it on, and that was the beginning of the high yield bond era. And as Malcolm Gladwell shows in his book Outliers, it's great to be at the front of the line. It's great to be in at the beginning. That's demographic luck. So I was very lucky to find a bond market that everybody in the world was prejudiced against, and it was on the do not fly list. That's where you find the bargains, the things other people won't do. And then in '88, I was joined by my partner, Bruce Karsh, who had the idea to start a distressed debt fund. And so in both cases, 78 and 88, we had the opportunity to form the first fund from a mainstream financial institution, and to get the first shot at some really inefficient markets. The world was a primitive place. Let's say 40 or 30, 40, 50 years ago. Can you imagine operating without any computers, any ability to find data, any internet? It was incredible. And I tell in the memo, I tell the story of Warren Buffett sitting in Omaha, paging through Moody's manual, looking for things selling at 2 times earnings. And of course, he could be successful because very few other people page through Moody's manual. And I mentioned there that if you wanted to study a company, you had to actually write away to the company and say, can I please have a copy of your annual report? And a couple of weeks later, it would come in the mail. The world's such a different place now that I just think you have to think big. I was lucky to find really virgin markets in the beginning, and that was my edge. And of course, also the fact that I was able to bring an equity analyst's habit of dealing with the future to bonds, because theretofore bond analysis was based on the present without conjecture about the future. So how can you knowingly take credit risk in high yield bonds if you can't speculate about the future? So I was lucky. It's a lot of aspects. I mean, direct lending, I think, is still a little less efficient, and in major down cycles, distressed investing is still somewhat inefficient. But I probably wouldn't stick in the high yield in the bond world otherwise. In answer to your question.
Thank you, Siman. Another question from you.
Yeah, so there are a couple of questions around tech companies and intrinsic value. So Steve says that, certainly there are many situations where traditional measures such as PE or FCF yield may be too narrow a lens to filter ideas. But given today's environment where many tech companies trade at 30x or 50x sales, not earnings, do you think valuations of tech companies may be stretched? And just to add sort of a note to that, Warren says that how do you estimate the intrinsic value of businesses? Most people are using non-GAAP measures as EBITDA. What is your take on that?
Well, I think clearly you can't. Just looking at something because it has a high multiple of sales, I mean, it's suspect, but it shouldn't be. It shouldn't automatically exclude it. I think you have to think about the growth rate in sales, what sales are going to get to in some period of time, and if you think it's 15, maybe you want to bracket that at 10 and 20. But what are sales going to be in 10 years? And then what kind of profitability is possible? You can't just look at price to sales. You have to have some suspicion about what a margin could be. And you have to apply that to sales and to produce EBITDA and cash flow. And you have to understand the capital requirements and whether the cash flow is free cash flow or not. You have to understand whether the company is now trying to be profitable or suppressing profitability by spending a lot of money for things like R&D and customer acquisition and that kind of thing. So you have to think about cash flow. I mean, I wouldn't recommend investing in anything without having thought about cash flow. But yeah, obviously, for a company that's newer and maybe unprofitable, you have to enter into some kind of conjecture. And the question is, can you find ranges for sales and margin? For example, that you're comfortable with, or is it really totally unpredictable? So we're still talking about valuation metrics, but applied to future potential, which is by definition more uncertain than applying it to the present data. And the last question, George, was on what subject, please? Remind me.
EBITDA was Samantha was about EBITDA, right?
Well, look, I mean, look, we all are faced with EBITDA. It's a good concept if you understand you can't just look at that, because you have to understand what the taxes and interest and depreciation and amortization are, what the needs are, and capital needs and so forth. But I think that adjusted EBITDA is really a bad thing, and one of the most important things for us to do is to de-adjust, because how profitable would my business be if I didn't A, or if I could count on B? It's too much conjecture, and we need a base case for EBITDA, and then we can make our adjustments to incorporate our suspicions with regard to the future.
Great, thank you. Let's see here from the raised hand. So here's an investor from Argentina. Javier, I'll allow you to talk. Okay, Javier. Okay, ask your question.
Your talk was like a punch in my face. So my question is the following. According to your point of view, it became very difficult to get an edge over other market participants. So my question is, should we drop the towel and change our careers? Another question is, what did you mean by you need to look further, more into companies to get a tiny extra edge when it comes to valuation? Thank you so much.
Well, I didn't want to punch you in the face. And if you're in Argentina investing, I would guess that the Argentinian market is less efficient than the U.S. market, and so that would tend to encourage interest in active equity management, stock selection. It should be more profitable for somebody with superior insight in a less efficient market. But I think that we all have to find out. We have to think about: are there inefficiencies? Are there securities that are priced in a way which is not reflective of their intrinsic value? Number one, so that is to say, is it a less efficient market? And number two, do you have the skills to be the one who finds them? Merely participating in an inefficient market is not a key to an above average return. It opens the possibility of above average return or a below average return because of the ability of asset prices to deviate more from intrinsic value. If everything's priced at intrinsic value, nobody can find any bargains or any overpricing. You can't do anything good or bad. You can only do average. And the same as everybody else. As soon as prices start to deviate from intrinsic value, now you have bargains, which the astute investor can find, or overpriced securities, which the sucker is going to fall for. So in an inefficient market, a less efficient market, you have more range of outcomes, is all. I still encourage you to keep looking, especially in Argentina. Now, should you give up this profession and take another? When I got out of school 52 years ago, investing didn't pay more than anything else. And I had 6 job offers, all kinds of different jobs, not accounting, not investing jobs, and they all paid the same, between $12,000 and $14,000 a year. So, we didn't go into investing in those days because we could make a fortune. It was just a very interesting job that we could do, and it still is. It's gotten harder to beat the markets, most markets, which tend to become more efficient over time, secularly. it's gotten harder to beat the markets, and the margin of outperformance has shrunk. But I still think it's enjoyable. It's a great intellectual challenge, and for people who are happy living in ambiguity, I think they should keep doing it.
Thank you. Okay, another question from Devin there. Sarah, I allow you to talk. Unmute yourself, please.
Yeah, my question was, there's been a lot of talk in the last couple of years. A lot of money has gone into low-cost index funds and ETFs. So in your opinion, over the long term, what's more profitable, value investing in individual stocks or just putting the money in a low-cost ETF? Thank you.
It's right. It's two different things. The reason for the flows of funds into the index funds and ETFs is that active management was unsuccessful on average. You know, when I went to Chicago in the 60s, they said the average mutual fund does not do as well as the stock indices. So why pay management fees for something which is unavailing? Why don't you just, maybe we should just buy one of every stock in the index. The concept of the index fund really wasn't out there. There weren't any index funds, but they said, well, why keep flailing around? Why not just go passive and buy a little bit of each stock in the index? And of course, that's what they do now. You have to realize that the success of indexation, which now accounts for, I think, the majority of mutual fund equity capital in the United States, passive investing, it's not because it was so good. It was because active investing was so bad. When you invest in the index, you're guaranteed to do what the index does. If you invest away from the index in active management, your results can deviate better or worse than the index, but on average, historically, it was worse. So passive is better and also cheaper. Now, when you say which is better, that or value investing, again, value investing, if you're a skilled value investor, you'll find great bargains and you'll make more money than the index with less risk. But if you're out there with negative skill, that is, you would do better if you flipped the coin. And there are people, of course, who just as there are above average skilled people, there are below average skilled people. If you're a below average skilled person, you would be better off in a passive fund. And if you make active decisions, on average, you'll make them wrong and you'll do less well than an index. So it's my mother used to say, what do you like better, the summer or the country? Is passive better than value investing? Passive is better than value investing by somebody with no skill, but it's worse than value investing with somebody with superior skill. It all comes down, in my opinion, and I wrote a memo about this, I think it was September 15th of 2015. It all comes down to superior insight. I mean, there is no rule, algorithm, school of investing, asset class, or formula that will make you always successful, or that can be shared and everybody can be successful. It's all of these things, and the question of concentration versus diversification, all these questions, and leverage versus non-leverage. They're all two-edged swords. They help you when they're in good times, and they hurt you in bad times. There's only one thing that helps overall, and that's superior insight or superior skill. And those are the people who should be stock picking.
Thank you. Simand, any questions from your Q&A?
Right. So actually, Ryan Kim has a good question, and Ryan has his hand up. So Ryan, do you want to just go ahead and ask your question?
Okay, I'll unmute him. Okay, I'll allow him to unmute. Okay, Ryan, unmute yourself, please.
Hello. Can you hear me?
Yeah.
Oh yes. Mr. Marks, thank you for the great insights. It's really a pleasure to talk with you. I feel like we've had many conversations before because I listen to you a lot on YouTube and podcasts. I currently work as an investment analyst at a value investing fund. I'm actually quite early in my career. And this question comes quite naturally as I work day and night to be a better value investor all the time. As the capital market is becoming more competitive and entry barrier lowering, it feels like we have to evolve continuously in seeking exceptional margin of safety or abnormal returns, if you can do it. But it's not so obvious and easy to maintain an edge outside your so-called circle of competence. What are some tips you have for investors to stay flexible and become fast learners into new things while maintaining the edge you have in your current circle of competence?
Well, I mean, you have to make an effort to learn new things. And after a few decades, Richard Oldfield said, well, why don't we just stick to what we're good at? And there's nothing wrong with that. But clearly the world changes all the time. And it doesn't make sense to think that the same methodology and specializing in the same kinds of situations is going to work from decade to decade to decade to decade. Now, might work for you. That is to say, might be a machine that you can operate successfully, but it's unlikely to be the most up-to-date machine. And the question is, how do you trade off expertise and experience in doing A versus the advantages of doing of trying B, which is newer and maybe has higher potential. Let me see if there's anything else I want to say on that subject. I think that the whole thing is about open-mindedness and trying not to have things that strictly delimit what you will do. Have an open mind and see if things can be like, for example, a lot of people say we don't do technology. And is that appropriate? Is there no case under which that a value investor can invest on a value basis in a tech company? Are they really unpredictable beyond utility? So that I would encourage a flexibility, in investing. Today's answer is not tomorrow's answer. The great thing about it is it changes all the time. And the actions of the people in the market change the market. George Soros calls it reflexivity. And I think that you have to be open-minded.
Okay, Mano, ask your question, please.
Thank you. And Mr. Marks, thank you. And what an honor for all of us. I just wanted to get your opinion on something else that is perhaps even more controversial than Bitcoin. So, this conference that we're having now is, pretty academic and professional. And the conversation on something like Reddit is sometimes anything but that. And yet some of the research that people have been doing there can be of the highest caliber. And now it has led to, I think, now 4 congressional hearings. So I'm just very curious to hear your opinion of this whole GameStop phenomenon and the conversation around naked short selling, if you've been keeping up with that, and just really hear your thoughts on it. Thank you.
Okay, this is outside my professional capability, but as an observer, I'll just say that I think that naked short selling, that we used to have something called the uptick rule, which you could only short on an uptick, and that prevents a bear raid. The bear raids were invented in the 1920s. Well, maybe it was before that, but they were applied in the 1920s, a term, and a group of people would get together and force a stock down through selling it. I'll sell it 9, you sell it at 8.5. I'll sell it 8, you sell it 7.5. We'll get it down to 1. We'll buy it, and it'll spring back to 10. And I think that the uptick rule prevented manipulation. So I think that was a good regulation of the short market. Now, naked, again, and permitting naked short selling is mostly dangerous for the short seller. You can lose an infinite amount of money if you're short naked. And the other thing is you can have an infinite amount of shorting if you don't have to borrow. And the amount shorted, like I guess in GameStop case, I think that the short exceeded the float. You can have more stock sold than exists, and that obviously introduces settlement problems. Now, most of the problems fall on the individual making the investment, but as our Keynote showed, things can be big enough to perhaps approach having a societal impact. And so certainly long-term capital management was an example of societal impact. It really moved the market back there in '98. I think for me, the most important single thing about GameStop and the meme stock phenomenon is that we're in a new era in terms of communications, and we can communicate with so many people so fast and so efficiently that if something like the Reddit bulletin board reaction on GameStop, if something gets a bunch of investors moving in the same direction at the same time in a relatively illiquid market, it can have incredible consequences, in both directions, of course. But let's say this was 25 years ago, and I'm sitting here in LA, and I say, I like GameStop. I get all my games there, and I don't like the fact that the hedge fund guys have been picking on it and knocking it down, and so negative. So let's give them something to think about. I'd like to buy the stock and make the stock price go up, but of course I couldn't do it because I don't have that much firepower. And there may be a guy in Seattle and a woman in Chicago and a guy in New York and one in Miami, and they all feel the same. They'd like to get in on it with me, but I could never find them. There's no way for me to connect with them. But now I can put it on a bulletin board, and I can find several hundred in 10 minutes. And we all go out, and we can, I wouldn't say collude, but we can pursue a joint goal, shall we say. And my partner, Sheldon Stone, talks about, well, what if you were on a boat and you were crossing the Lake Erie, and the captain came on, he says, okay, everybody get to the left. And everybody goes to the left. He says, now everybody run to the right. And everybody runs to the right. And back and forth, and it starts getting rocky. That's what happens if you can get a lot of people moving in one direction or another direction in a concerted manner. And I think that that's a reality of our new technological environment. And there'll have to be some regulations, maybe some trading stops, but we're certainly a new era, and we shouldn't ignore that.
Thank you so much, Howard, for this wonderful and thought-provoking presentation and the lively interaction with the audience.
Thank you.